Hey guys, Whitney here. Welcome to today's Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And I do this class live every Tuesday, so you have a place to come to learn the ins and outs of passive investing, as well as ask questions in our Q&A session that we do live every single week. Now, if you're listening on your favorite podcast player of choice, I encourage you to attend live so you can take advantage of those question and answer sessions. Anyways, the whole point here is for you to be able to gather the information you need to go confidently into your next investment. And if you haven't already done so, be sure to check out PassiveInvestingWithWhitney.com. There you can check out our future masterclass and skills bootcamp sessions, see our open deals, and if you'd like, hop on the phone with me. We can talk all things passive real estate and how these investments will fit in your portfolio. Now, today we are going to tackle a hot topic here: the top 5 tax benefits of investing in passive real estate. Now, I am not a CPA, okay? So I'm merely going to arm you with information. So take notes and be ready to take this back to your accounting and CPA team and see how this might apply to your personal tax situation. Now, really, again, what I do here is to help you get comfortable with passive investing, because maybe you've tried to do this before and you're just like, you just really couldn't get comfortable with passive investing in general, but all the different nuances with it, with, taxes, legal stuff like that. Or maybe you've actually invested in a deal before and you went, uh-oh, I made a mistake. Okay, either you got in the wrong deal with the wrong operator or used the wrong bucket of funds to invest. Or maybe you're just completely overwhelmed by all the information out there. You just don't even know where to start. Now, that's what I help you do here, is demystify passive investing. Because really, at the end of the day, it is a simple investment. Okay, now we can make it complicated, but really, it is a simple way to get involved in passive real estate or add real estate as a complement to your portfolio. Case in point here, my story, I started off investing in 2002 in rental property completely by accident. I bought a house with a significant other. Relationship fell apart about a month later, and I had a house. I had everything under my name. I completed the rehab on this property about 11 months later and turned a nice profit on that. That's when I realized I actually made more in that one transaction that I did in my nights and my weekends than I did in my day job that had me traveling almost 80 hours a week. Now, fast forward, I did a lot more live-in flips and house hacks on my own. My husband, who's pictured here, he joined me in what I call my antics. But really, we finally realized, live-in flipping and house hacking isn't going to get us to financial freedom. We need a way to produce reliable income that does not require our time to be involved in it. Right? So we went with what we knew at the time, which is, okay, we've lived in rentals. Let's buy some rentals. Let's take some of this hard-earned cash from our day job, our savings, and also what we've been making at these flips, and invest them in rentals. Now, we scaled a portfolio of over 36 single family properties. We bought a small multifamily building, and then we're like, man, we're still too involved in this process. This is taking up too much time. By this time, we had our daughter. We wanted to do more traveling. We needed a way to really unhook our ability to earn an income by the time involved. And that's where passive investing in real estate really stepped in. Now, we still do some active projects on the side, even today, but the bulk of our portfolio is invested in passive projects, because really that's what helps support our ability to earn income, tax benefits, diversify our portfolio, as well as large equity gains without the direct involvement in our time. Now, fast forward, our portfolio looks about like this. Some other investments on the side here, 6,500 multifamily units, 2,200 self-storage, 15 express car washes. But again, it's that result that we're all here after, is how can we leverage real estate in a passive manner to get 100% choice on how we spend our time? It's not all about leaving your job, right? It's about having choices. Okay, that's really what we're after here. We are after that freedom of choice and how you spend your time. And we can help you do that here at passiveinvesting.com. We have some 1.4 billion assets under management and very strong returns to our passive investors. Now, I know today we are going to focus on those top 5 tax benefits of real estate. But again, I have to reiterate, please don't take this as financial advice, legal advice, or tax advice. You have to take this back and consult with your team to understand how what I'm discussing with you here today applies to your unique personal situation. I see investors so often want to listen to a bunch of webinars, try to save money by learning as much as they can, and then try to do their taxes themselves. I used to be like that myself. I can tell you that is not the way to do this, guys. Okay. It is worth it to get a high quality accountant that understands real estate, understands passive real estate, and help you create a strategic plan. Now, I want to show you these tax benefits because this is going to help you clue you in whether your current accountant is the person that needs to re-interview for their position, or if you need to go seek another one before the beginning of the year and get that tax strategy in place. So let's dive into some of the tax benefits of real estate. Now, we are not, I'm going to tell you right now, we are not diving into opportunity zones, real estate professional status. We're not getting into those nuances because there are 5 things that for which anyone in real estate can do right now. Okay, we're going to create an order of operations here because most people have it wrong. Okay, most people, and if you grew up my generation or a little bit after, we're trained to pay taxes. Okay, maybe this narrative rings true with you. Go get an education, get a nice high-paying job, as high as paying as possible. Stuff some savings aside. Maybe you go get a house, whatever, but buy that house, qualify for your standard deduction on your taxes, and then stuff as much money as you can into your retirement fund for, cross your fingers, hopefully one day you can retire. And if you have money left over, then invest in some outside assets like real estate. Okay. But in reality, okay, this is us giving money to the IRS when really the IRS is our partner. Now, I know when I was growing up, every year when my parents would do their taxes, there was a lot of grumbling going on. Like, when are we going to get a refund? How come we have to pay so much in taxes? It's because they never really understood that the IRS is actually your partner. The tax code is actually a treasure map on where the government wants you to put your money in order to help them solve problems. Okay, so this is a mindset shift. Okay, so if you've ever looked at the tax code, the first 10, 20 pages are all, how do you pay your taxes? The rest of the tax code is how can you leverage deductions, entities, shifts of income, okay, credits. How can you qualify for credits? And then how do retirement accounts apply to you? The rest of the tax code is how you can lower legally your tax liability. Okay. Now, what problems does the IRS therefore want you as an investor to help solve? Well, that's simply put, they want largely for you to invest in real estate, businesses, things like oil and gas. Bills come online all the time. Maybe it can be clean energy, but they want to spark investments into these particular areas because the government doesn't want to be the primary producer in those areas. They want the investors to invest in those areas. Why is this important? Okay, because if you can understand that this is a treasure map, the IRS tax code is a treasure map, then you can leverage this treasure map to help you shelter income. But be aware, don't let that tax tail wag the dog. Okay, so many investors I have partnered with, or I've had the pleasure of coaching, they get into real estate and they're just trying every which way to save on their taxes. Okay. That's fantastic. And let's not lose sight of getting in a high quality investment. Also, whatever the IRS gives to you, they have the opportunity to also take back if you don't continue to stay invested in the market, like in real estate, like in business or oil and gas or whatever. Okay. How do they do that? Well, they can actually, when you go to sell assets, say like you have purchased a rental property and you go to sell that rental property, they assume you have to take depreciation on that. And we'll get into that here in a second. And so they assume that you are doing that to be able to shelter some of that income tax free. So whenever you go to sell, if you're not going to reinvest it into another asset, like through an exchange or something like that, they're going to take it back. They're going to take part of that depreciation benefit back through depreciation recapture or having you pay capital gains tax. However, they want you to stay invested, okay? And so the IRS gives opportunities for investors to continue to move their capital gains and their recapture liability forward, okay? This is kind of like playing Monopoly, right? We have the camp version, the national parks version. So you're going to hear me say tents roll up into campgrounds. If you got the older version, four greenhouses equals one red hotel. You continue to trade up your properties through exchanges or other type of strategies, like through installment sales, opportunity zones, deferred sales trust, or charitable trust, in order to continue to move that tax benefit or tax recapture down the road. All right. So we determine what we're talking about today. Okay, those tax benefits, and why are they important? Why should you be paying attention to these? Okay, it's because let's not. Hopefully, your eyes are open. You now understand that the IRS tax code is actually a treasure map. Okay, all right. If it is a treasure map, what are kind of the order of operations here? What are those top 5 benefits we need to be looking at in order to figure out how do they apply to our portfolio? Well, there's an amazing book out there I love by Tom Wheelwright. It's called Tax-Free Wealth. Before Tom wrote this book, though, he had a lot of information posted out there about kind of the basic order of operations. All right, this is like that 100,000 foot view plan to kind of help you bust through the myths of that you have to pay taxes. Okay, no, you should leverage the tax code in such a way that you can legally reduce your liability. And the order of operations work like this. Try to reduce your income through strategic deductions. Convert how income is earned, okay, according to IRS rules. Shift income, okay, on how income is distributed with entities. Eliminate income through credits. And then defer your incomes using qualified retirement plans, for example, self-directed IRAs, solo 401ks, etc. Here's the thing. Most of us, I'll raise my hand, we were trained to do number 5 first. Get a nice high-paying job, pay our tax bill, and stuff as much into our retirement account as possible. That contribution to our retirement account was probably the only way we could reduce our tax liability. All right, that's number 5. There's 4 steps that we can take advantage before then. Here's the thing. You have to participate in business somehow. You have to be an investor, all right? And that's very important for us to understand, okay? Because otherwise those first 4 steps really aren't available to us. So let's tackle step number 1. Step number 1, most people will only be able to take the standard deduction. Why? Because they don't have a business activity going on. Owning real estate, investing in passive real estate is a business activity, okay? The business will allow you to take more deductions legally before you pay the tax on the income, right? In real estate, we can use these losses to offset passive income within that particular investment. And if our losses are great enough, we can use those losses against other passive investments, all right? So what are some of the biggest powerful losses that we can take. And I'm not talking about you actually lose money. You can investing. I'm talking about those losses, paper losses. Well, the first one, the first two are like one of the biggest reasons why people love real estate is depreciation. Okay. So the IRS knows that if you buy a property or invest in a property, that property has to be maintained. So they're going to, and that it has a useful life. And so they're going to say we buy a multifamily building. They say that the useful life of a multifamily building is 27.5 years if it is not maintained. So they want you to maintain it. Remember, the IRS wants you as the investor to solve the problem. So they're going to say, hey, Mr. Investor, okay, we're going to take the building, not the land. Land doesn't depreciate in value. We're going to take the building and we're going to divide it over 27.5 years. Each year you get to take equal loss, right? Well, some investors were like, whoa, that will take forever for us to save up losses to replace roofs, to replace windows, the like, or replace carpeting and some of these things that break down faster than 27.5 years. So we have a different accounting method in place that we can take advantage of, which is called accelerated depreciation. Now, this requires us to do what we call a cost segregation analysis. Hire an engineer, and that engineer is going to go through and label out all the different components of that building. Okay, all the carpet, the flooring, the cabinets, light fixtures, you name it. And anything that would depreciate in 20 years or less, now we get to fast forward to the first 5 years of the hold of the project. Now, here's the thing. As a passive investor, the operator takes care of that for you. You don't have to brain damage yourself to try to figure out how to get that done. Okay, the operator can really help you leverage that part of the accounting method, depreciation accounting method. Now, these are awesome. Okay, so those are ways that we can move depreciation to the early parts of the project, one of the most powerful tax benefits of real estate. But right now, we also have another depreciation incentive layered on top, which is bonus depreciation. Now, this was written into the tax code back in 2017 Tax Cuts and Jobs Act. And, it states that we currently in this year, we get to take that, we say we perform a cost segregation analysis and we get to fast forward $400,000 of depreciation to the first 5 years of the project. I should have said $500,000. We'll say that, make the math easy. Well, that would mean you would take $100,000 each year for the first 5 years. Well, this tax incentive says, hey, you know what, Mr. Investor or Miss Investor, why don't you go ahead and take 80% of that in year one? So that means we get to take $400,000 in year one, and then we take the other $100,000 and break that up over 5 years. Okay. Now, this incentive is what we call sunsetting. Okay, last year in 2022 was 100% bonus depreciation. This year in 2023, it's 80%. Next year in 2024, it'll go down to 60% unless there's a tax law change. Okay, but this is how we can leverage that first step. Okay, how can we take deductions? And some of the biggest deductions, the reason why real estate is so powerful is the use of depreciation, accelerated depreciation, and bonus depreciation. But there are other deductions that we can take too. Okay, we can write off interest for the business loan, our taxes, our insurance, repairs, maintenance, all these things related to the property on the left-hand side. And also other things related to the property on the right-hand side. But some of those, you can own a property in the area that you love visiting. Go visit the property while you're on vacation. You might be able to deduct part of your business and travel expenses, right? So this is another reason why real estate can be so powerful. Now, step 2, convert that income, all right? Step 1 was leverage your deductions to shelter your income. Now we need to figure out how to convert it to pay the lowest amount of taxes. And here, if you are familiar with Robert Kiyosaki's work, this is the cash flow quadrant over there on the right-hand side of the screen. Most of us are trained to actively earn our income, okay? Meaning we trade our time for dollars, okay? This is the employment sector, the E sector. All right. Now, some of us realize, oh, we can actually do this for ourselves. So we're going to leave our job and we're not going to become self-employed. We're going to do this for ourselves. Okay. We call them small business owners. This is typically somebody who has like less than 5 employees. Okay. They tend to stay more in the S quadrant. Now here, I would love for you to go to your chat box, okay, or the Q&A box. Help me out with the Q&A box, guys. Who on this chart pays the most in taxes? Just write the single letter answer there in the Q&A box. Who pays the most? Is it the employee? Is it the self-employed? Maybe you think it's the business owner or the investor. Ooh, we got a lot of people coming in. Employee, employee, employee. Oh, I got a couple of people who got it right. Thanks for participating in my little mind-bending game. It's actually the self-employed person. Why is that? It's because now, not only do they have to pay taxes on their income, they have to pay self-employment tax, because if you're in the E quadrant, your employer has been paying the employment tax, okay? It's actually the self-employed business owner that actually ends up paying most in taxes. This is going to be, think about it, this is going to be your dentist, your doctors, your lawyers, your engineers, private engineers. So it's super important. Now we can bump up in our income. That's why a lot of people do it, is they can, make more, if they struck out on their own versus working for an employer. But now they're increasing their tax liability. Okay, so if the self-employed person gets the highest leverage in taxes, how can they now shift those taxes? We need to move to the right-hand side of the quadrant. Okay, either the self-employed person can now start building a business, okay, leveraging all those other perks of LLCs and shifts of income and all the other things in the quadrant, or they need to figure out how to become an investor, like investing in real estate, investing in businesses, investing in passive real estate in order to acquire those tax benefits to reduce their income. Okay, so what we're trying to do here is actively shift our income from the E and S quadrants and shift that stuff, as much of that active income as we possibly can, into the business and I quadrants. And for most of us, most people are going to be better investors than they are business owners. Okay. And so again, that's what makes passive real estate so attainable. All right. Now, how can we also shift income and use other tax brackets? All right. This is another way. This is step 3 on how we can reduce our tax liability. Now, you might be scratching your head here. You were like, I thought we were going to talk about the specific tax benefits of real estate. We are, because real estate helps us shift our income from active to passive income, from earned income to passive income. Now we get to start leveraging the power of entities to shift our income, okay? It's hard to shift our income if we don't have a business running, okay? This is hard, okay? You're probably going to be stuck with paying capital gains in any asset you sell, either long capital gains or short capital gains. But if you have a business, now we're talking. We can actually start leveraging, hiring our dependents, okay? I have a daughter. She's 11 and a half. She is a far better whiz at social media and computers, quite honestly, than I am. And I always thought I was pretty good. But she takes on a lot of, the bookkeeping responsibilities and, leveraging things on social media. I pay her for it. Now she has a standard deduction here, okay, of up to $11,000. Okay. Now this isn't her standard deduction, guys, but it's actually a little bit more than that. But I could write a job description for her, pay her, and that income now is not taxed. It's not taxed because I've taken it, instead of me paying for her activities directly and now having to pay taxes on that income and then pay for our activities, I can actually pay her Okay, and she can leverage her standard deduction, not pay any dollars, zero taxes on it. And now she can pay for her own activities. She can also save in a Roth retirement account, right? But you have to have a business. Okay, you have to have at least a piece of real estate in order to make, qualify for that. But you can also leverage entities a different way. Maybe you are already a business owner. Work with your accountant to figure out how you can, reduce your taxes through the qualified business income clauses. You leverage LLCs, corporations, and the like in order to reduce your tax liability. Okay. All right. Point number 4. How can we eliminate income through credits? Now, we can leverage real estate to attain this too, okay? When we, invest in real estate at the entity level, at that asset level, we can, implement some energy saving, strategies, water saving and strategies that can help, create tax credits at the investment level. Maybe the investment itself is maybe an opportunity zone or, has some sort of tax abatement on it. That can help eliminate one of your largest expenses, which is taxes. Okay, there are, on a personal level, maybe you can get an investment tax credit. Or if you employ other people, you can get an employment tax credit. All right. Now, there's other ways to eliminate income as well. That is contributing to some, IRA sanctioned, accounts like a flex spending account, health savings account, Roth, retirement account, or a whole life insurance. Those are other ways to kind of help eliminate create credits and eliminate income tax. Now, these 3 vehicles, HSA, Roth, and whole life, these vehicles actually avoid provisional income in retirement. And you can also use them to invest in real estate. Yes, you can open up a self-directed HSA account, build up enough capital in there over a few years, and then go invest in real estate. That can be done. You can do the same in your Roth as well. All right. All right. The last stage, and we can also leverage this with real estate, is defer income. Okay. We can actually contribute to our self-directed IRAs, either traditional Roth or qualified retirement plan like a solo 401k, SEP, or simple, and we could go invest in real estate. All right. So there's some amazing ways and benefits to do that. Now, remember, this is retirement income. That whatever income the asset generates has to go back into the retirement account. When you reach retirement age and you pull out any funds beyond your standard deduction, you're going to have taxes. Okay. You might also, if you use leverage to buy the asset, you might have what we call a unrelated business income tax associated with there. So make sure you're partnering with your CPA. Now, remember, this is step 5. We need to make sure we're doing the other 4 steps before then. But also with your retirement account, you don't have to actually buy, a piece of property. You can, lend it to others. You can invest in fix and flips. You can partner. You can invest in syndications. You can invest in other funds. All right. Now, here is how kind of these, and I actually went over more than the top 5 benefits of real estate. I really would have been remiss if I kind of like cut you off at step 3 and didn't share the rest, but make sure you're partnering with your CPA to reduce income through strategic reductions, leveraging the top 3 benefits of real estate, which are depreciation, accelerated depreciation, and bonus depreciation. Next step number 2, convert how income is earned according to the IRS. Okay. Again, we want to take our active income and shift it into passive income as quickly as possible. That is another benefit of buy and hold real estate, because it is passively earned income. Shift income utilizing entities. Maybe you have your own business, your own real estate. Leverage the, paying your dependents. You got to put them on payroll. But also, if you're investing in real estate, you can use, LLCs, the sole proprietorship designation, and corporations. Eliminate your income through tax credits, and then lastly, consider after you've done all that, investing through IRAs and qualified retirement plans. Guys, this was a lot of information we covered today. So this is your invitation to action. If you haven't already done so, join us at passiveinvestingwithwhitney.com. There you'll join our passive investing club. You'll get free one-on-one call with me to discuss your goals, free access to other master classes and boot camps, and priority access to our open deals. And if you're here live, don't go anywhere. We're about to start our Ask Me Anything session.